All right, bosses, let's talk GDP, gross domestic product. Sounds fancy, right? Like something your economics teacher says right before everyone falls asleep. But what is it really? GDP is basically the value of everything a country produces, all the goods, all the services, all the hustle in a specific period. Think of it as a giant scoreboard for the economy. It's how we keep track of whether the country's been grinding or just taking a nap. If the number's going up, things are booming, people are working, spending, and Mr. Whiskers just upgraded to premium catnip. If it's going down, well, that's when everyone starts cutting subscriptions they don't use and pretending that's a financial strategy. Nominal versus real GDP. There are two ways to measure GDP, nominal and real. Nominal GDP is like your paycheck before you remember taxes exist. It shows what things are worth right now, no adjustments. Real GDP, on the other hand, adjusts for inflation. Basically, it says, hey, maybe prices went up, so let's see what's actually changed. If your paycheck stays the same, but your rent, groceries, and cat treats all double, congratulations, your nominal income stayed flat, but your real life got worse. So, real GDP is nominal GDP, but with a reality check. The famous equation. Economists love this part. Y equals C plus I plus G plus X minus M. No, that's not your new Wi-Fi password, that's the GDP formula. Let's break it down. C, consumption. That's what people buy. Snacks, sneakers, streaming subscriptions, and yes, luxury cat towers for Mr. Whiskers. When people spend more, it usually means they're confident. When they don't, it's probably because they checked their bank app right after payday. I, investment. This isn't about buying stocks. It's when businesses invest in new buildings, equipment, or expanding production. It's money spent now to make even more later. Think of it like Mr. Whiskers upgrading from one scratching post to a whole cat tower. It costs more now, but he'll get years of returns. G, government spending. Basically, when the government goes on a shopping spree, roads, schools, hospitals, and whatever else they think will keep things moving. They pay for it by taxing people or borrowing money. If they spend less than they collect, that's called a surplus. If they don't, well, that's called Tuesday. Just kidding, the real term is a deficit. X minus M, exports minus imports. This part shows whether a country sells more than it buys. If exports are higher, that's a trade surplus, the economic version of we're the main supplier now. If imports are higher, that's a trade deficit, or as Mr. Whiskers says, we're just paying someone else to make our toys. So why does GDP matter? Because GDP is like the economy's pulse. When it grows, businesses expand, jobs open up, and everyone feels a little richer. When it shrinks, even Mr. Whiskers has to downgrade from salmon pâté to plain tuna. Governments use GDP to plan budgets, and businesses use it to forecast demand. And smart bosses like you use it to understand the bigger picture before making moves. It's not perfect. GDP doesn't measure happiness, innovation, or how many people are scrolling through memes at work, but it's still one of the best ways to see how productive a country really is. So next time someone talks about GDP growth, just remember, it's the country's way of saying, hey, we made more stuff this year. Simple as that. And before you start running numbers in a spreadsheet, remember, this isn't financial advice. It's just business education, boss style. So if you learned something today, hit that like button, subscribe, and keep building your empire one smart move at a time.